The next critical warning signal that will arise in the global economy is when central banks, particularly the Federal Reserve and others, decide to step in and purchase bonds once again. While it might seem like a solution, this action represents a significant risk. This is because it signals a deeper problem within the economic structure, especially when the next economic downturn happens. If we take a moment to reflect on the economic actions of my generation, it becomes evident that we have allowed debt to accumulate without sufficient regard for the long-term consequences. We've allowed our infrastructure to deteriorate, and rather than fixing these issues, we've opted to borrow against the future. This accumulation of debt, in essence, is borrowing forward. It shifts the financial burden onto future generations, with the expectation that they will somehow manage to repay it. But how exactly do we plan on addressing the cost of this debt restructuring and the necessary renovation of the infrastructure? The answer isn't solely found in money. It's important to understand that money, in its essence, is a tool that produces productivity. It serves as a measure of value and effort. However, the real challenge will be the work required to overcome the deficits created by this enormous renovation project. Yet, this situation isn't as complicated as it may initially appear. At the core of this issue are two fundamental groups, debtors and creditors. The system must operate in a way that works well for both. Lending, for example, must be incentivized and rewarded, ensuring that creditors receive sufficient compensation for the risks they take. When debt is accumulated, it creates an obligation to repay that debt in real terms. Not only must the principal be repaid, but the interest must also be paid in real terms, adjusted for inflation and the actual value of the currency. Without this, the lending system will break down, as creditors will refuse to lend money if they believe it will not be repaid in a meaningful way. There are two main choices in dealing with debt: pay it back in hard money, money that retains its value, or print more money, which leads to inflation and the devaluation of the currency. This second option, which involves monetization, is often the path taken by governments in times of crisis, and it has historically led to significant devaluation of the currency. This cycle is not new. It goes back to biblical times, where debt jubilees were held, and the same patterns have played out over centuries. Debt tends to rise faster than the income necessary to service it, creating a dangerous imbalance. Looking at different societies throughout history, we see this same pattern emerging. In our current situation, the cost of servicing debt has risen to unsustainable levels, and as deficits continue to grow, the amounts of money needed to pay back these debts will only increase. If this balance isn't properly managed, the creditors will eventually sell off their debt, causing further instability. It's not just about the creation of new debt, but also the existing debt that can be sold, leading to imbalances in the market. This can trigger a crisis of confidence in the currency and in the economy as a whole. In the past, when the system reached this point, central banks intervened by printing more money to buy up the debt. At first glance, this may seem like a way to stave off a financial collapse, but it comes with significant risks. This process, known as monetization, undermines the value of the currency and disrupts the entire economic system. While this strategy has been employed many times throughout history, it always comes with the same result: an eventual devaluation of the currency and a loss of confidence in the monetary system. This brings us to the example of Japan. Over the past few decades, Japan has been grappling with an economic situation that has become increasingly precarious. By printing vast amounts of money, the country has seen its currency depreciate significantly. This depreciation has led to a dramatic loss in purchasing power for bondholders, who have seen the value of their holdings drop by as much as 80%. This serves as a cautionary tale, highlighting the dangers of excessive money printing and the devaluation of currency. The same dynamics are likely to play out in the United States as the federal government continues to face rising debt and increasing pressure to service it. As debt service payments grow, there will be less room for discretionary spending, leading to a squeeze in the economy. This will become especially evident as entitlements, which are fixed payments, consume a larger share of the federal budget. In this environment, the federal government will find it increasingly difficult to meet its obligations without resorting to further debt issuance, potentially exacerbating the crisis. The real risk will come when we reach the point of bond selling. When investors begin to sell off their holdings in U.S. government debt, it will create a massive imbalance between the supply of debt and the demand for it. This could lead to a sharp spike in interest rates, further compounding the economic problems. The moment this happens will be a red flag for investors, signaling that the stability of the financial system is at risk. While it is impossible to predict the exact timing of this event, historical patterns suggest that it is likely to occur within the next few years. As we approach the next economic downturn, it is crucial to consider how to protect one's portfolio. In times of uncertainty, gold and inflation index bonds emerge as strong candidates for hedging against risk. Gold, in particular, has proven to be an effective diversifier, as it tends to have a negative correlation with other assets. This means that when stocks and bonds are performing poorly, gold often performs well, making it a valuable asset for portfolio construction. Inflation index bonds, which are tied to inflation, are another excellent option. These bonds are only weakly correlated with other assets, and they provide protection against rising inflation. Together, gold and inflation index bonds form a solid foundation for a diversified investment strategy that can weather the storms of economic turbulence. These assets not only provide a hedge against inflation, but also offer stability in times of crisis. However, it is important to maintain a broad perspective when considering alternative forms of money. While some people have become enamored with Bitcoin as a hedge against inflation or a store of value, I remain skeptical of its long-term viability. The issue with Bitcoin, as I see it, is that it is unlikely to offer the privacy and freedom that some people hope for. Governments can and will regulate and tax Bitcoin transactions, and they may even find ways to shut it down if it poses a threat to the financial system. Furthermore, Bitcoin remains a relatively small market, and its behavior in times of crisis is still uncertain. While some view it as a safe haven asset, I believe that its lack of widespread acceptance and regulatory uncertainty makes it a risky investment. For these reasons, I would recommend allocating only a small portion of one's portfolio to Bitcoin, if at all. Instead, gold remains the more reliable choice for those seeking a non-debt-based store of value. Ultimately, diversification remains the key to a successful investment strategy. By holding a mix of uncorrelated assets, such as gold and inflation index bonds, investors can reduce their overall risk while maintaining the potential for strong returns. In the face of mounting economic challenges and the growing risks associated with debt, a well-diversified portfolio is the best defense against uncertainty. As someone who has spent decades studying markets and investing, I have seen firsthand how economic cycles unfold. The key to successful investing is not trying to pick the next big winner, but rather constructing a portfolio that is resilient in the face of changing economic conditions. This means understanding the importance of diversification and taking a long-term view of one's investments. To that end, it is crucial to think about money not just as a medium of exchange, but as a store of value. In a world where debt is rising and the purchasing power of currencies is under threat, the ability to preserve wealth becomes paramount. For this reason, it is essential to consider both traditional assets, like gold, and more innovative options, such as inflation index bonds, to build a robust investment strategy that can withstand the challenges of the coming years. As we move forward, it is important to keep in mind the broader economic forces at play. From government debt to geopolitical tensions, the global economy is facing a complex set of challenges that will require careful navigation. However, by understanding these dynamics and making thoughtful, well-informed decisions, investors can position themselves to thrive in an uncertain world. In conclusion, the next economic crisis is likely to involve a combination of rising debt, inflation, and central bank intervention. While the exact timing of this crisis is difficult to predict, the signs are already present, and investors would be wise to prepare for the eventuality. By focusing on diversification, embracing assets like gold and inflation index bonds, and understanding the broader economic forces at play, it is possible to mitigate risk and preserve wealth in the face of economic uncertainty.